All right. What are your thoughts? Here live from the compound. My name is Downtown Josh Brown. Here with my co-host, as always, Michael Batnick. Michael, say hello to the folks.
Hello.
All right. Guys, if it's Tuesday night, that means it's time for an all-new edition of What Are Your Thoughts? For those of you who are new to the show, welcome. We're going to talk about some of the most important topics happening right now in the markets, the economy, the business world, technology, etc. And we're going to have a little bit of fun along the way, hopefully. But before we get started, we do have a sponsor tonight. Michael, tell us about tonight's sponsor.
I saw a stat. The sponsor is public. I saw a stat recently about how much money is still sitting in checking accounts, earning 0.5%.
How much? Like more than you would have expected?
Like literally trillions. I don't remember if
nuts.
it's like 12 or 20. That's not a bit much, but it's a stupid number. What are you doing? What are you doing? It's so easily.
I'm part of it. I have some money sitting. At like a giant bank that I just.
Yeah, so do I, to pay my bills.
Pay my bills.
Yeah, of course. I got to pay my bills.
No, but probably more than I need.
Well, that's on you. I use
the public app. I have sent a bunch of money there. I should have, in hindsight, for the last 6 months, should have been sending more than I have been.
You don't like free money. I do. So that's why I use public. 5.1% on your cash.
It's pretty dope.
Not bad.
And guys, by the way, no fees, no subscription required, no minimum balance requirements, and you can move money unlimited. As many transfers and withdrawals as you want. There aren't any penalties for doing that.
I think what you meant to say is best of all, kids, it is liquid.
That's right. Liquid as water, my friends. Okay, so check out the Public app, public.com. This is a paid endorsement for public investing. 5.1% APY is as of March 26th, 2024, subject to change. Full disclosures can be found in the podcast description. All right, so this is the biggest question, the price action in Nvidia. And I want to specify price action because nothing really fundamentally has changed. So just pure price action in Nvidia's stock from last week to this week. Did we just top out, like at least for the time being? Or are we right back into the uptrend with today's bounce? I think that's like probably the biggest question most market observers are trying to figure out right now. What do you think?
Calling tops is notoriously tricky.
Of course.
I would say...
Not this one.
Yeah, what do you mean?
This one looked and felt like a top as it was topping. Not just in hindsight.
You could probably find many examples of this one. But what I would say is you have to give the bulls the benefit of the doubt. As crazy as this has become, it's innocent until proven guilty. There will be dip buyers. Do we take out the recent highs? I don't know. But I would say is the scale of Nvidia, it's just incredible. In 3 days, it lost $430 billion in market cap. Yeah. That's the size of MasterCard. Only 14 companies in the S&P 500 have a market cap more than that.
So to recap, this is a stock that basically became the largest market cap in the world.
Only the 13th company to do so ever.
Yeah, it surpassed Microsoft by over $100 billion, and then within 3 days it was down 13% from the high. Like, if you don't call that a top, what is a top? Because that is going out. That's going out with a bang.
Well, Nvidia had a similar 3-day decline just a couple of months ago. The stock lost 20%, and then it gained 90% in a couple of weeks.
When was that? February?
I'm looking right now. I think it was April 16th to the 19th. Oh. I'm going to check as we talk. But listen, I don't know. Is this the top? I would say plus.
Listen.
I would say plus. You got to give it plus odds. Like when you say a top or the top are two very different things.
Yeah, I don't want to say it's the top for the year. I want to say that it's the end of that unbelievable, miraculous run, and I think we'll probably see it in bear market territory.
All right, so if you recall,
that's what I'll say.
If you recall, way back in the month of April, this thing, as I just mentioned, I was right. It fell 13% in 3 days. It was in a 20% drawdown from its high. This is 2 months ago. And then it stopped going down, and it ran from 76 on April 19th.
Pre-split.
Right. Yeah. It ran from 76 to $1.40.
but it was never at those prices. It was 760.
Fine.
And it ran to 1,040.
Right.
Well, it's
Right,
important
right,
for
right.
people to remember. So that was pre-split. This is, though, a textbook bearish engulfing candle.
Sure.
So this is a chart formation that actually Jeff DeGraff called this at the end of last week.
So he nailed it.
Absolutely nailed it. He says short term, yes, this is the top. And I want to just give you a definition, textbook definition of a bearish engulfing, and then we'll get into Jeff's research. A bearish engulfing candle is a technical analysis pattern that signals a potential reversal in an upward trend. It consists of two candles. The first is a smaller green or white candle indicating a continuation of the current uptrend. This is followed by a larger red or black, like fully colored in.
I think I could do a better job. I think I could do a better job than Investopedia. No
the body of the, can I finish? Completely engulfs the body of the first candle. So it's higher and it's lower and it's filled in because the price went down. This pattern suggests that selling pressure has overtaken buying pressure, indicating a shift toward a bearish sentiment in the market. So let's put up Jeff's chart, Mike. This is what it looks like. You see that last dark black candlestick?
Oh, I see it. So
Yeah.
the important thing is, doesn't matter if it's white, red, or black, because people use green. I use green and red.
Correct. Just it's full. It's not. And it's
What
not hollow.
matters is the open is higher than the previous day high.
Yep.
Okay, and the close is lower than the previous day low.
Right. It engulfs the entirety of the prior day.
The entire thing.
So Jeff is pointing out there was an outside reversal in March. That was the peak for almost 3 months. And you got a 20% correction from that high, which I think is what you were describing.
That's exactly right.
Okay, let me just read what Jeff had to say. Leave this chart up. Nvidia is clearly the king of the AI trade, but parabolic charts don't last and eventually succumb to much-needed consolidation or corrections. Given the sentiment extremes and the outside reversal, we expect that there will be further profit-taking in Nvidia. A similar 20% correction would put Nvidia just back to where it traded at the beginning of the month at around $110. So chart off, not catastrophic, like not the end of the world. If a stock just went from 70 to 130, you can live with it going to 110. Like let's all take a beat. But I think that's likely. I think another 20% correction is likely. You're talking about a stock that's up 190% on the year, and it's not like it did nothing last year. Let me show you some examples of previous bearish
Before we do that,
chart
can I say one
patterns.
thing? Before we get
Please.
to the previous ones? I think that, I don't know if I think this will. I'm going to say give me like plus 400 on this call.
Long
It-
shot.
Yeah, it's a long shot. It could, actually, maybe not that high. It could fill the gap all the way down at $96 and remove the entire recent blow off top. That is, and guess what? It still wouldn't touch the 200-day moving average. That's how overbought. That's how overbought this thing is. So that would be, a significant decline. But it wouldn't be anything in the context of what this thing has done. That would be a 28% decline, and it wouldn't even register on the long term chart.
Yeah. Pre-split, it would still be $960.
And it wouldn't necessarily mark the death of this thing if it fell 30%. Go ahead.
Point guys are always talking about pre-split because I'm thinking about like the muscle memory that people have from watching this stock, and if it never split and it fell from 130 to 950, 1030 to 950, you probably wouldn't feel like it went down as much, even though percentage-wise it's the same thing. So that's the negative of a stock split. Here's the S&P 500, January of 2018.
That's
You've
not
got-
this.
Yeah, this is not a great representation. Let's do the next one. These aren't like big. These aren't
All right,
big
whatever.
enough.
Close
Throw
enough.
it out. Doesn't
Close-
matter.
yeah,
It's
close enough, yeah.
These are chart patterns that people pay attention to. You don't have to yourself, but
I respect this.
Yeah.
Like on that, we were actually recording. It was Thursday, right? It was Thursday. This thing gapped up And the open was basically the high of the day, and it was nothing but selling pressure for the rest of the day. So it opened up 3%, closed down 6%. That's a massive swing. And after a gigantic run, you have to respect the selling pressure. Doesn't mean that it's the top, but certainly was a top.
Yeah, I don't think there's meaning in every tick, but I think when you get an open that's a gap higher, it's just like the maximum amount of demand hitting the stock.
Yes.
And then if within the same day, or if you're looking at this weekly, within the same week, you go out at a lower low than the prior day, the meaning there is that everyone who wanted to buy has now bought, and prior buyers are now turning into sellers. Like, that's it. That's what that means. It's not tea leaves.
No.
Like, it's looking at actual activity.
Yeah. And Josh, even better, this bearish engulfing happened at an all-time high. An all-time high.
And with the stock having become the largest stock in the world, which, as you pointed out, this is not an event like every 4 years, like you get a new president.
Right.
Like we really just do not have a lot of these stocks throughout history. Very few stocks have been the largest stock in the world. So it's notable. We'll keep an eye on it. I don't think the correction's over. Would be my takeaway. You're up.
Meanwhile, what's Nvidia up today? Right now, it's up 6%. So yeah, these things doesn't mean that a new high is going to be taken out. It's tricky. Who knows? We'll find out. Okay. Anything else to say on that, Josh?
No. I wanted to show people some examples of prior bearish engulfing, but we couldn't get our shit together.
That's okay.
We'll do that some other time.
That's okay. All right. So what I found particularly fascinating about the overall market within the context of the king getting dethroned, albeit momentarily, is the market didn't budge. And it would be kind of hilarious if the Nvidia trade cools off and money just rotates into everything else. So even with Nvidia in a 13% drawdown, the S&P is less than 1% from its all-time high. Even the equal weight, which has been shit, is just 3% from its all-time high. The Dow is 2% from its all-time high. So money is rotating, and I want to run through some charts and then get your thoughts. So remember Jim Paulson from the Ritholtz Group?
Yeah, I like that guy.
So he put out some really, really killer stuff over the years, and now he's got a Substack. So he made a good point. He said in the contemporary bull market, concentration has been so intense, most stocks have not participated excessively, making the bear's job much more difficult. Without broad economic or stock market vulnerabilities, an imminent recession or bear market may remain elusive. And I think what he's saying is that people might have it backwards. You're saying that if the Nvidia, I'm using air quotes, bubble or whatever, maybe it's a bubble, who knows? If the AI trade loses its steam and that what had been propping up the market falls apart, well, what do you have left? Well, guess what? The rest of the market might take the baton. The rest of the market hasn't done shit. So chart on, please, John. So the charts that we're about to show, he's looking at the prior bull markets and what happens over the next 20 months. So he's looking at the bottom in 2009, the bottom in 2002, and the bottom in March 2020 versus the current bull market.
What does this measure? Cumulative advanced decline is not just today snapshot, but it's adding up from the low, the winners versus the losers.
That's exactly right. How many stocks had advanced on a given day versus how many declined, and then you add them all up. Yeah. And to the point that I was just making, this rally has not been that broad-based, supporting the fact that maybe it's like, I think Mark Dow said you can't break a leg jumping out of the first floor of a building. Next chart, please. This is interesting. This looks nothing like the prior bull market. So in the previous bull markets,
dude, this looks like a bear market,
right? So we're looking at the equal weight divided by the S&P, and SMID caps led off the bottom in 2009 dramatically. Same thing in 2002. Same thing in 1990 to a lesser extent in 2020. And this one just this is a Frankenstein bull market. Yeah. Small cap stocks, next chart, please, looks exactly the same. Small cap stocks have gotten the shit kicked out of it, which is very unusual coming out of the bottom. They tend to lead the rally. And then super interesting, when you look at the cyclical names, materials, industrials, discretionary, and financials, they all look like junk. So, John, we could just scroll through these pretty quickly. Materials, here you go. Discretionary, same thing. Industrials, woof. Is there one more? And financials. Okay. So, Josh, what do you think about this idea that the mega cap stocks or Nvidia specifically may stall, and perhaps money flows into some of the things that have lagged this market.
Well, I love what he's saying, because his point is that if you lose the leadership, it doesn't mean the money comes out of the stock market. It means the money goes into other areas of the stock market. And in point of fact, while Nvidia was getting the shit kicked out of it in an alley yesterday, the oil stocks were catching a bid. I'm not saying that's one for one every dollar out of Nvidia, but think about it. If 200 or 400 billion dollars are coming out of one stock, it's not all going into money markets. That's just
true.
The people that own Nvidia, the up 500%, are not money market people. They're going into more risk. So, like, definitionally, we should stop thinking about leadership getting taken out and shot as a negative catalyst for the overall stock market. Now, percentage-wise, mathematically, yeah, it's not great for the S&P 500 when the biggest components are all bleeding market cap, because that means their prices are down and the index is down. But if you have a diversified portfolio, it's probably not as terrible as you would suppose it is. And look, man, I got healthcare stocks. I got biotech stocks going up. I got shit cooking right now. And it didn't matter that Nvidia had an almost 15% drawdown in 3 days. Like, it did not negatively affect the market. I don't care. I know that's what people thought would happen. Oh, just wait till Nvidia comes down. That's curtains closed. No, that's literally not what happened. So
if Nvidia falls 20, 30% and the market doesn't really do much, like, what are you going to say now, tough guy?
Nothing. And I have Apple hovering above 200. So is Apple not a counterbalance to Nvidia? So you're going to say no? I mean, they're going to say something.
Holy shit, look at Google. Is this an all-time high? Oh, yeah. Yeah.
What is it, HOD?
Bursting.
Yeah.
Bursting
right, so I have Google. So what are you going to tell me now?
Right. Microsoft.
So I never believed in that bullshit where the leadership stocks, what are you talking about? You know what I'm saying? Somehow, and sometimes stocks that are not leadership get what's called a battlefield promotion. You know what a battlefield promotion is?
No. Tell me.
Like the corporal gets shot in the head, the guy running behind him. Hey, congratulations, you're the new corporal.
Next man up.
Take these guys over the ridge, and you're running the company now. You're right. So Eli Lilly took the baton from Tesla. Tesla can go fuck itself. Eli Lilly got a battlefield promotion. Yeah, look at it.
Holy cow!
It's magnificent. That's how it works. It doesn't work the way people like to scare people and say, "Uh-oh, once Apple and Microsoft fall, game's over." Not necessarily. Not always. Look at 22. Look at 2022. They beat the crap out of the Mag 7 names, but ExxonMobil had an amazing year. Chevron, ConocoPhillips. There was money to be made.
There was money to be made. The indexes did get killed, though.
Killed. Fine.
Yeah.
Fine. But still. All right.
I like to end it on a but still.
Can we talk about the Boomer Candy ETF article?
Yeah.
Do you know this writer, Jack Pitcher? Is he new?
I don't know Jack Pitcher.
This is a hot article.
That I looked at the author and I didn't recognize the face or the name, I should say.
Yeah, this is a hot take.
Let's go.
So this came out June 23rd. Was that Sunday? Mm-hmm. Anyway, here's the gist of the story. These hot new funds are boomer candy for retirees. Okay, so basically, he's looking at the ETFs that use derivative strategies to not give people direct market exposure, which ETFs have historically done, but give them like some version of protection or some feature like higher income. But what they all have in common is they're asking you to forego some of the upside of the stock market indices, which, by the way, this is perfectly fine. There are some people who would just prefer, I'll take less upside, but in exchange, either I want downside protection up to the first 15% drop, or I want like sell covered calls and pay me the premiums in the form of like an income dividend. I'll take that. So this is very old school. There's nothing really new about it other than A, the ETF wrapper, and B, how popular they've become. Am I getting the story right?
Mm-hmm.
Okay. What were your thoughts when you read it?
Yeah, I want to be careful what I say, but generally speaking, I am a big fan of these vehicles. They're not all created equal. But Josh, do you remember? God, this is a long time ago. 2012. You and I were in a meeting with the wholesaler, and he was pitching junk bonds, and he called it, or maybe you called it. Somebody called it chicken equity. And this is as we were still reeling from the GFC. And you're like, all right, so this is like a way for people to get like beta to the market, but like not own the whole thing, right? Remember that?
Yeah.
Okay. So that's a shitty way to get stock market exposure, in my opinion.
Yeah.
If you are able to define your outcome, let's start in products you can. If you're able to invest in the market and put guardrails on how much downside you could take, I think from a behavioral point of view. Now, are these portfolios like optimal? Shut up. Doesn't matter, dork. It matters if people can get what they want to get and have an experience that they weren't able to previously get inside of a liquid wrapper. So yeah, I'm a fan, and I'm not surprised at all that these things are boomer candy. Matter of fact, one of the best calls that I made in my career was when we first spoke to Bruce Bond at Innovator ETFs about what they were doing in 2018. I said to Ben, or one of us said, like, this is going to be a huge category. And it is. It's a $120 billion category. And this is a secular bull market as long as rates remain where they are.
This is
rates
really interesting.
Go ahead.
What you just said. It's a secular bull market because it is. Typically, you see these types of buffer ETFs or covered call ETFs get really, really hot right after the stock market has cratered.
So 2022, these were hugely popular.
All right. So, but they took in $31 billion over the last 12 months, and the stock market has been going straight up.
Yeah, people love them.
So it's not just a bear market phenomenon anymore. There are two main categories here. Let's define these really quickly. Equity premium income.
Yeah.
So basically, the fund buys large cap stocks and sells covered calls against those positions. They bring in options premium, and that way they could pay out the dividends of the stocks plus the options premium, and they're like targeting 8 to 10%. And the negative there, and again, negative, people are aware of it, they're capping your upside, and they're charging you a decent fee in order to carry this operation out. And again, that's a great trade-off.
Well, some of them are pretty reasonable. Like the biggest ones, like JEPI is like 35 basis points.
So is JEPI the category kill? It's JP Morgan's version.
It's 35. It's huge. It's like a quarter of the assets. Now I would say this is for a very particular investor. This is for an investor who doesn't want, and would know thyself, who doesn't want all the smoke. And yeah, if in a bull market, you're going to lag. That is what is going to happen. But I think that you know that going in. It's not a surprise.
Right. There's anything. This is one of the main things I learned from Nick Murray. Anything you do to reduce potential volatility, if you do it reliably, like all the time, the net effect is going to be that you minimize your upside.
Yeah.
By some degree.
Yeah, definitionally.
But know it. All right.
Yeah.
The other type is a buffer fund, and this is what you were talking about with the innovator funds. So buffer funds use derivatives. They are trying to guard against losses up to a point, and again, the trade-off is you're limiting your potential gains. So there are funds where they'll say we are going to eat the first 20% of your downside. Great. What do I give up in exchange? Well, you can only get 2% of the S&P 500 a month. Yeah. Or you only get the first 15% of the S&P's
but
upside
what I like
for
is
the course of the year.
People can decide. You could say, okay, you could take 10% losses. We'll cap you at 10% losses, but you're only going to get 7% upside. And somebody could say, nah, that's not for me. I don't like that trade. Okay, fine. You could take 20% of the downside and get 18%. Okay, but the point is you can decide, which is
you can calibrate and
So I think what some like hardcore quants might say is, well, you could do this in a more efficient fashion. Well, what about a 60-40 portfolio that accomplishes the same thing? People don't always look at their portfolio as a whole. We know this very well. people look at the line items for better or for worse. For worse, obviously. But they
look at the individual holdings.
They look at the individual holdings. That's just what we do.
Well, if they do that, let's pull up this chart. So this is JEPI, which is up since inception in 2020, 63. I don't know if that's inception. Maybe I just asked for a 5-year chart. This is up 63%, and the S&P is up 96%. It's a really big difference. But again, you can see that the ride was somewhat smoother.
Way smoother. Look at that drawdown starting in 2022.
Right. And so that's what you're paying for, and that's where you have to set your expectations. And I think if you're an advisor allocating to this, you're going overboard in setting those expectations correctly.
Well, look at the next one. But JEPQ didn't lag by nearly as much. And these are both...
JEPQ is based on the NASDAQ instead of the S&P?
Yeah, so previous chart, please. So JEPI is active. So JEPI is active. So the stock selection is active, and they really don't look like the S&P 500. So it's not really the greatest. They look more like the Dow. It's like a more quality portfolio.
Active quant, or there's a PM?
Yeah.
Well, which?
It's active quant.
Okay. Now this one is just purely based on the triple Qs?
Yes.
JEPQ?
Yes.
Okay, so this is not terrible. 36 versus 47. Obviously, the Qs beat it, but it's a runaway bull market.
Yeah.
And it won't always be. And I don't know what the income is on this. I don't know what they declare it every quarter, right? Because they can't declare it for the year.
I think it's like 7 to 9%, something like that. But what I would say is, as long as people know what they're signing up for, I love the idea of being able to narrow your band of outcomes. Because with the S&P 500, your outcomes is a mile wide. You don't know what the market's going to do.
All right. So I think I heard Bob Elliott talking about this stuff a while back. And he was saying, just wait until there's a volatility spike. Why is that the risk for these products? Is it because of the type of options that they're trading in?
I can't speak to it. It depends on the particular fund. But what I would say is one of the most important things is these are not, again, there's a lot of them, but the JEPIs, that's not a hedge. It's not a downside hedge. It's income. That's why you buy that product. It's income and it's a smooth ride.
It's capped upside coupled with income.
It's not capped upside. You're selling covered calls. So it's not technically it's not capped.
No, of course that's the capping. You sell a covered call, you get called out of a stock.
No, but I'm saying it's not capped. It's not like that the most you can make in a given year is 8%. That's what I mean.
Agree, but definitionally, selling covered calls is capping your upside. You will get if you have a stock that runs up 30%, but you sold calls that are 10% above today's price, you will get called away.
You're not getting all of the upside.
Correct. Okay.
Anyway, this thing is a massive category, and
you know what?
It's only going to get bigger.
And you know what? I'm surprised it took this long because these would have made sense 10 years ago, as much sense as they make today.
I don't think there was the mechanism in place, legally, for the ETF structure to hold these.
I think that's right. But these strategies are as old as dirt. We were selling reverse convertibles with creating buffers for clients on individual stocks. We would have clients, rather than trade a shipping stock, that we would use the contract 90 days, and you would basically say, we will not knock you in until the price falls to this level. Which
and they were illiquid.
Horrible.
And the commission sucked.
Worse than illiquid. You had the counterparty risk, not of the stock.
That too.
The counterparty risk was of the issuer of the note.
Right.
Because he's traded as QSIPs. Mm-hmm. Guess who was the number 1, 2, and 3 underwriters?
Lehman.
They're all gone.
Stearns.
Lehman, LaSalle Street Bank, and ABN AMRO. Bye.
Yeah. Yeah. So in my opinion, these are a little better.
Okay. I wanted to dislike them when they launched, but I totally get why they're useful. I am not using them personally, but I understand.
No, it's not for us. But I knew that these were going to be big.
That's right. All right. You're up.
All right. What else is there? Oh, okay. Okay. You're seeing a lot of headlines that look like this. New York City landlord to sell office building at roughly 67% discount. So here's a story on this one. There's a 10-story building on 44th Street between 8th and 9th. And let's be honest, that's not exactly...
That's our old street.
No.
We were on 44th and 5th.
Right. But this is between 8th and 9th.
Yeah.
So not who the hell is getting office space there?
Nobody.
Crackheads. Nope. Right. Exactly. So the details of the story are juicy. So this company owes more than $100 million on the mortgage. And they
Dude,
sold it. They sold it for less than $50 million.
That's literally Port Authority. It is the worst area, other than the Lower East Side. It is the most unlivable, unworkable neighborhood in all of Manhattan.
You insulted them a little bit. You insulted them a little bit.
Deliberately. I don't understand why they're not literally removing the crime and drugs from those corners every day.
Okay,
There should be Army reserves there.
My point is, all we see are headlines like this. Okay.
Yes.
And I'm not saying that the real estate situation, the office real estate situation, is good. It's definitely not good. However, I'm just asking questions. Are things not quite as bad as the headlines make it out to be? So we stole this chart from Torsten Slok, commercial property indices year over year.
This is
and
great.
Industrials are rocking ass. But look at the pink one. Look at office. It's getting a little bit less catastrophic than
Office
it had.
is rocking less ass.
Yeah, no, office is definitely not rocking ass. But I had Chart Kid make a chart of there's 7. I am throwing SLG. There's 7 office REITs in the Russell 1000, and it's a mixed bag. The ones on top are not. Or actually, some of them are doing terrible. Kilroy Realty is doing terrible. Alexandria Real Estate, whatever. But on the bottom, you've got some ones that are doing okay. They're hanging in there. SL Green looks pretty good.
Can you put up the prior chart? So here's the thing. Whenever you hear commercial real estate in your mind, you have to say, well, wait a minute. These are not all the same exact thing.
Right.
There's national, meaning they're in every city, which includes some of the worst. There's office, which is specific. And some of them have overlap, but apartment is not office.
No, hell of a rebound.
Industrial is not office, but they're both commercial. Retail, that's its own world. That's got its own drivers and its own positives and negatives. So
next chart. So the headlines are bloody, but look at the average of all these 8 REITs. Does that look like a terrible chart to you? It actually looks kind of buyable.
So what's really interesting in places like New York, there's crowding into the A buildings. So it's not universal that quote unquote office real estate is weak. No, actually, One Vanderbilt is full. One Madison is full. These are marquee properties owned by
and
SL
all-time
Green.
high prices.
Correct. These are $250 a square foot, and they're full. And the reason why is because there's been a flight to quality. Now, B and C buildings, Midtown South, 30s. Of course that's going to look and act like shit. Yep. And you're going to see headlines about 60% discount liquidation sales because that shit was always worthless. But now people are actually booking the loss and trying to move on and fix their portfolio.
Yeah, so guess what's happening? Different. The equity's getting wiped out or the equity's getting crushed. Okay, good. It already did. We know.
Yeah, that's right. So it's not as black and white as a lot of people think. I still don't want to buy any of these, including industrial, including retail, because they're highly cyclical. And in the next downturn, they're going to get destroyed.
Yeah.
Like everything else gets destroyed. They are extraordinarily pro-cyclical for the most part, maybe pulling out hospital REITs or old folks' homes. These are not the types of things that I want to personally put money into.
What's the Amazon REIT? The one that houses all their data stuff?
Prologis. But again, PLD. But again, super pro-cyclical. Let's face it. Let's stop bullshitting each other.
Yeah, and these names are super volatile.
Of course they are. Yeah. So there's other things you could do for income. And, this is not the only game in town. So I'm not really hot and heavy about these stocks. All right. Hottest trade of the year. Almost every one of these is related to the AI data center build-out theme, which is crazy. 4 of these names are power providers, and 3 are utilities. Let's put this table up. These are the hottest stocks of 2024, circa end of June. So first half of the year, let's say. Super Micro up 190%. Nvidia up 138%. This is as of this morning. Vistra Corp, this is a utility, plus 130%. Constellation Energy, utility, plus 85%. Micron, related to AI. All right, so now I'm through the first 5. They're all AI. Number 6, NRG Energy, utility, up 60%. This is AI. All right, GE Aerospace, this is kind of like a turnaround story, not AI. Fine. Eli Lilly, this is bull market and fat people. Okay, not
Fat
AI.
people AI.
Fat people AI. All right, First Solar, up 51%. AI.
How?
Because it's the most cost-effective way to build these data centers and power them.
Oh, did not know that.
Yes. The chart went vertical this year
Yeah.
when they started getting contracts for all these build-outs. Targa Resources, this is energy. It's like oil, gas, whatever. But like, it's amazing. This one theme cuts across so many sectors, and pretty much the hottest trades in the market are all in some way related to the AI theme. And that's really it. Like, it's not that there aren't other things worth investing in, but AI and GLP-1 drugs and everything else is like might as well not even exist. And that's a really interesting feature of the bull market. Let's put up this chart. So here are the three utilities plus First Solar. I mean, these stocks look like AI stocks, but they're some of the most boring companies ever until this year. It's really interesting. This thing up 130%, Vistra, is really something to see. And there's been a little bit of a dip recently, but still, these are some hot ass stocks.
Okay, counterpoint. I just punched up Y charts, comp tables, S&P year-to-date total returns. There's an ass ton of stocks that are up over 20% of the year, like tons.
Yeah, I just showed you the top 10.
Yeah. So the biggest ones or the biggest winners surely are AOI, but like Wells Fargo, Wells Fargo's up 20%. Citigroup's up 20%.
Yeah.
I mean, there's a lot. A lot of stocks are working. So yes, Nvidia's carrying the market.
Oh, yeah.
But man, a lot of stocks are.
I'm just giving you. What I'm saying is,
my Domino's pizza's up 30% on the year.
I think there are years where you pull up the market and the 10 best stocks, you don't have as much concentration.
True.
In terms of like what theme is driving this. This year, it's pretty much one thing.
True.
Pulling out Lilly. So.
Okay. Who is this? Is this Peter? Yeah, Peter Kafka tweeted, "It's boring to keep saying cable TV is collapsing, but boy, oh boy, is cable TV collapsing. Pay TV, including digital substitutes like YouTube TV, which we're going to talk about in a sec, and Hulu Live lost a record 2.37 million subscribers in Q1. That's a drop of 6.9%. Not nice. Wow."
Well, why am I still paying? My last
Dude,
last asshole in town.
I just saw my
cable bill is like $280 a month.
That's it?
What am I doing?
Yeah.
What am I doing?
I actually just saw mine today. It's funny you mentioned that. $315. I said, this sounds high. Why are we spending $315 on cable? Plus everything else that we're spending on.
I gotta call Fios. I think I'm paying for like 9 cable boxes.
Yeah,
what
sure.
What is a cable box even?
By the way, House of the Dragon episode 2. Oh my God.
Rocks ass. Do you know that there's that one scene in House of the Dragon that's it's worth paying the entire year's worth of HBO from my perspective. It's Risa Fans who plays Hightower, like the older guy.
He's so good. Who is that guy?
Oh my God. He was in Notting Hill. He had like a spaghetti strainer on his head. He was like the idiot roommate in Notting Hill.
What?
Yes.
He was also. I was saying he looks like he was a Robin Hood, Prince of Thieves too.
Nope. He's Hugh. What's his name? Hugh
Grant.
He's Hugh Grant's idiot roommate from
Yeah.
Wales. Anyway, 30 years went by, and he's like a fucking Shakespearean actor.
Yeah, it's incredible.
That scene with him and the young king and the knight.
Yeah.
They're like, dude. It's almost like they're on stage doing a play.
So good.
Just unbelievable. Okay. Yeah. I don't know why I'm paying this much, but you know what? For my new apartment, we're not getting any cable. None. We'll have broadband, and we'll have Netflix and HBO Max and all our apps and zero cable box, like zero everything. I'm not paying anybody. I'm just finished.
Yeah.
That's it. I'm done. And if I could live that way while I'm there, I'm gonna come back to New York and rip all that shit out of the wall because it's too much money, and it's not clear that I can't live without it. I just never tried to.
So Lucas Shaw was writing at Bloomberg. He said TV ratings for the NBA Finals fell from last year. I mean, that's not surprising. It was pretty bad finals. But it was one of the least watched finals on record. Even ratings for House of the Dragon premiere was down 20%. And YouTube TV, which is a much smaller number, but still, throw this chart on. This thing had never seen subscriber outflows. This lost subscribers for the first time. So I think there's also a ton of options for free TV now. Like free is huge, and yeah,
they're all competing with TikTok and Instagram Reels and free YouTube. Like that is what has the attention of people under the age of 30.
Well, guess what else?
Definitively,
75% of Prime Video watchers use the free option.
Right. No, so they'll watch the commercials.
Yeah, okay, big deal.
That's me. I don't care. I'm full circle. I would have paid anything to get rid of commercials 10 years ago. I'm an Amazon Prime subscriber. Now they threw commercials in my face. You know what? What am I going to fucking die? It's fine. It's not the $3 a month I care about. I don't feel like making the phone call or going on the internet and finding the right box to click.
Yeah.
Just show me the commercial.
Well, I'm
not that busy.
I do hate them. Okay. Speaking of that, I'm going to make the case for Amazon, a stock that I own that I added to this week.
Okay, pitch me. I own it, but maybe I'll buy more.
So I'm not going to spend a lot of time on the fundamentals because honestly, this is like a technical call more than anything. But I do think it's notable.
What do they do?
What does Amazon do? They do a few things. Wait, what? What was the question? All right, chart on, please. So again, in that Lucas article, he was showing that when it comes to video ad sales, the point was that Netflix is really nowhere. But look where Amazon is. And Amazon is just ramping up. And I think this is going to be a monster money machine for them as they ramp up.
Oh, wow. Look at this. They're nowhere.
They're nowhere. And they're just getting started.
Yeah, so, now it's default. They're not saying, oh, here's an ad supported tier.
It's not opt in. You have to opt out.
That's right.
Yeah.
Now it's default. That number's going to double.
Nobody's opting out. Well, 1 out of 4 are opting out.
We
so that's
explained it.
Yeah.
Right. Okay.
All right. So Amazon has really, I don't know if a lot of people are aware of this. Amazon has really lagged bigly over the last couple of years. We could, so I'm cherry picking. This is the top or the bottom, I should say, whichever one you want to look at it in terms of like performance versus the Qs. So since July 2020, John, next chart, please. And then we could scroll back. So since this chart peaked, it's the ratio of Amazon divided by the Qs. So the outperformance, which lasted a hell of a long time versus the Qs, this peaked in July in the summer of 2020. Previous chart, John. So since that peak, the Qs have gained 96%. Amazon has gained only 30% over the same time. Next chart. This is showing Amazon's market cap compared to Microsoft, Apple, Nvidia, and Alphabet. And it's, next chart, I'm sorry. It's by far the smallest of the bunch. Does it deserve to be? Yeah, I don't think it's like that crazy. I don't think it should be $3 trillion, but it's lagged its peers big time. And on a technical basis, it looks clean. This is the daily chart. It's failed here a few times at 190.
I think it's going to 250. I went on TV and said this is my lock of the week. I was joking, obviously. If I could only own one stock from now to the end of the year of the Mag 7, this is the one I would buy.
Okay. And then last chart on a weekly basis, longer term.
Because of the combination of the size and their positioning for AI. And we talked about this with Kantrowitz. Like, it's all upside from here because they haven't gotten any of the benefit.
It's not in the stock at all.
No, it's not.
Yeah. So that's it.
So, all right. I like it. Put me down for another 12 shares. I own this thing. I probably want to own more of it though, to tell you the truth, because I didn't really buy enough that it'll matter. If
guess what? Guess what? Market's open tomorrow.
That's right. That's what I love about the markets. All right, I have a mystery chart for you on screen. All right. So this is I don't know if it's consumer discretion. It's like entertainment. All right. And what I want to tell you is that it is. I'm just trying to think of like what the best hint that I could give you.
All right, let me ask you. Maybe this will help.
All right, the stock gets all right. The stock's biggest product cycle is every fall when football comes back.
Okay.
That's a good hint, dude.
That crash in 2019. Is there a story there?
I mean, it's the story of humanity. You gotta give a little to get a little.
Okay,
Sometimes
so
you
football.
win, sometimes you lose.
It's okay. I don't know what that means. It's a football related stock.
That's like the biggest driver every year of its annual sales is when football comes back around. What could it be?
Football. Give me one more clue.
Okay.
It's not Under Armour, right?
Okay. Last clue. No, it's not. That's not a terrible guess, but it's not Under Armour.
Am I in the right universe?
It's not apparel.
Okay.
So it's not Nike. It's not Under Armour.
Okay.
So what else is related to football but not apparel?
Oh, beers.
You went the wrong way with it.
Okay.
You want one more guess? One more clue?
One more.
Okay. It's got 2 letters as its ticker symbol.
All right. What's the stock? Oh, that's good. Okay.
That's good, right?
That's good.
We haven't talked about this in a while. Would you buy this chart? Sight unseen, like knowing if you didn't know it was electronic arts, just looking at it, you would buy this setup, right?
There's too much resistance. I think I would wait for the breakout.
The resistance only goes back to 2020. It's not a decade's worth of resistance. That level is 150, dude. Would you buy this thing at 151? You would.
Hold on. I'm just looking at this. Okay. Would I buy this? I would just wait for the breakout. There's no reason to be early here.
Okay.
But let's set it up.
I got some more shit for you. Put up the next one.
Yeah, it's setting up.
So this is the setup right here. This is now. So now you got a 50-day back above the 200. You've got an RSI climbing. We'll probably get into the low 60s pretty soon. So on the breakout, you're getting that relative strength confirmation, which I always love, and I know you do too.
I'd rather buy it at all-time highs, to be honest.
Look at this. What's the next one we have, guys? Do we have one more?
That's all she wrote.
No, I have one more. I have one that goes back to Inception. I thought maybe I didn't send it.
No.
All right. And anyway, I do have a video I want to show you.
Oh.
John, can we?
Holy shit.
This is Field Sense, powered by Boom Tech. Authentic one-on-one impacts fueled by physics. But Field Sense isn't just Boom Tech.
Now you see me, now you...
It's spectacular new grabs.
Hold up, wait, stop.
And more control across the field, so you can combo killer new hezzies with wicked new jukes.
Stop.
And elusive new ball carrier mechanics.
Okay, I gotta give it all you.
It's time to buckle your chin straps and lower your shoulders.
Wow, that looks
So
so
you
real.
can
Check out
dominate
running.
in franchise mode with the top new rookies and fresh playbooks.
Look at me go.
Because nothing hits like magic.
Sick.
That looks sick, right?
Sick, yeah.
That's your catalyst. That's what's going to pop it above 150. It's got some new technology in there that does not exist right now. This is the opposite of the iPhone, where every new iPhone is just incremental.
I just don't
that's a
buy
big leap
that
forward.
Madden as a catalyst. Like the investors don't know. They don't know it's coming.
All right, can I share with you who made the cover for Madden 25, which is they're up to 25 this year? CMC, motherfucker.
Yeah.
Let's go. Dude, Christian McCaffrey. By the way, that's a great pairs trade. Long EA, short McCaffrey stats this year because they put him on the cover.
Right. Yeah. It usually works like that.
It usually works that way. Anyway, shout out to Electronic Arts. This is a setup that I am watching and
Stalking.
And if and when it pops up through 150, people are going to be talking about the stock again.
Mm-hmm.
And it's been consolidating for years. So it might get interesting. All right, that's it from us tonight. Don't forget, tomorrow is Wednesday, which means an all-new edition of Animal Spirits with Michael and Ben. That'll be followed by Ask the Compound with Ben on Thursday, and a very special edition, I won't say any more,
So special.
of The Compound and Friends.
Might be the show of the year. No disrespect to any guest. It might be the show of the year.
It definitely could be. That'll be Friday. Jill on Money Saturday. Keep it locked with the compound. We'll talk to you soon.